Well, I think people, I think last year was the one where I kind of had this big growth in terms of awareness, and this is kind of like the continuation of that. That's kind of how I view this year. And if anything, it's people, I get questions like, what are you trying to do to grow next year? I'm like, I'm not trying to grow next year. I want to consolidate. I want to, focus on work-life balance. I want to like streamline certain things. So it's certainly, certain things over the past, let's say 2020, 2021 accelerated, very quickly, more than I would have thought. And so it's kind of been like keeping up and trying to manage that. I guess the way that I approach it is I want to, keep it accessible to people as much as possible. So free content and then low cost content. Yeah, so I think first we have to go back to what they were doing before this announcement. And so Japan's doing something called yield curve control. So normally central banks control the short end of interest rates, like they'll determine overnight lending rates. But the longer term bond markets, like a 10-year Treasury, a 10-year gilt, a 10-year JGB, it is supposedly set by the market, right? So the government's issuing debt to finance itself, and then the market is pricing that. However, in very indebted countries, as long as that debt is denominated in their own currency, which is the case for developed countries. That's kind of the key differentiator between developed and developing countries in a market sense. As long as they're in that situation, they can override the long end of the curve too, not just the short end. It's considered more extreme policy. And a famous example that I like to point to is back in the 1940s during World War II. A number of countries did it, including the United States. So in the United States, we're fighting World War II. Our fiscal deficits were absolutely massive. A lot of people envision that's being spent overseas, but a lot of it's being spent domestically. You're building manufacturing. You're hiring people. You're sourcing raw materials, and this is very inflationary. Big expansion of the money supply, and so the inflation in the U.S. averaged 6% per year that decade. From let's say the early 40s to the early 50s, and the highest inflation print was 19% year over year. And they just held bonds. Like the short end of the curve was held near zero, and then the long end of the curve was held at 2.5%. And so the entire Treasury yield curve was submerged well below the inflation rate, no matter how high inflation got. And the way that they do that is the central bank says, we'll buy every bond that tries to go over this yield target, which is another way of saying, because when yields go up, it means bond prices go down. It's another way of saying that if bonds go below our price target, we will buy unlimited bonds to get them back above that target. And that also, what that does, that makes the private market want to do it for you, because if the Fed says, okay, we'll buy any bond that goes over 2.5% for more than a couple days, and let's see, during a middle of a day you have a bond go up to 2.6%, well, then maybe JP Morgan wants to come in, buy the bond, and then they can resell it to the government the next day at 2.5% and make a little gain, right? And so it's almost like it can hammer itself down, because they know if it stays above that limit, the central bank will come in and just buy it back down to that limit. And so it's reliant on the credibility that the central bank's actually going to do what they say. They don't want to be left holding the bag if on a random Tuesday the central bank says, actually, we're not going to do yield curve control anymore, right? Because then all the people that were holding bonds get screwed. So anyway, with Japan, because they're in a very high debt situation, right? So when you have super high debts, 100% of debt to GDP, 200%, that's just the government debt. In Japan, it's over 200%. If you do the calculations, if they had 3% interest rates, 4% interest rates, how much of a percent of GDP would that be in interest every year? It'd be outrageous. And so they're kind of stuck in a similar environment where they're holding yields really low, and they were holding them before at 0.25%. So they were willing to buy any 10-year Japanese bond that tries to go over 0.25%. And so essentially what happens is most of the market just sells the bonds. Other than certain pools of capital in Japan kind of have to own bonds, big insurance, pension, things like that. But if you're not like a forced buyer, essentially, if you have alternatives, you get out of Japanese bonds, and essentially the Bank of Japan ends up owning half of them, and the market becomes very thin and rarely trades. And also it means that if the market is not allowed to express its view on inflation and appropriate interest rates through the bond market, they will instead get out of the bonds and sell the currency, right? So it ends up being expressed on the currency instead. And so you had an unusually weak year for the yen, because they were the one central bank that was really kind of doing hard yield curve control at super low rates, while the rest of the world was trying to tighten. And what we saw in the past week here was that the Bank of Japan adjusted their yield cap from 0.25% to 0.5%, which doesn't sound like a lot. It's still below the inflation rate. It's still unusually low compared to what you can get in most other developed country bonds. but it is a big percent increase. And it also, it goes back to that point where you spook the private market that's supposed to be doing the yield curve for you as much as possible. Because now, if a private entity comes in and says, well, I can just resell this to the Bank of Japan, you never know that, Japan could come out and say, actually, it's 0.75% now. So, right. So that it's kind of harder to maintain a second target. And so it's kind of a trade-off, because one thing I actually argued earlier this year was that Japan set the peg too low, right? I mean, you could argue that they shouldn't have a peg, but realistically, when you have debt to GDP that high, they're going to have a peg. And then the question is, where do they set it? And I think that they set it unusually low, because it's very hard for them to maintain it that low. And I think they're kind of adjusting back up to a more maintainable level, but they have to reestablish credibility, because people can say, well, if they changed it once, why can't they change it again? So they're creating new bank reserves to buy them. So debt is being issued as long as the Japanese government is running a significant deficit, which they are. So that's where the debt creation is coming from. And then the money to buy that debt it's not creating debt, it's just creating new money, right? So the risk there is that it can be inflationary. And so basically more of that debt is being converted from being held by the private sector to being held by the Bank of Japan. They're printing money to buy them. So it's essentially debt monetization. And, the challenge in that environment is that basically they're saying outright that we need our bonds to lose purchasing power for the math to work, right? So Japan has an official 2% inflation target. Inflation's currently above their target, and yet they're saying we're going to cap yields at 0.5%. And the short end of the curve is at negative 0.1%, I believe. So it's the last remaining negative nominal yield. So when you look at the whole Japanese yield curve, it's submerged below not only the current inflation rate, but their target inflation rate. So if you add everything together, they're saying, wait a second, you want bonds to lose value over time. And then, the answer is yes, we do, because you can't have 200% debt to GDP and have positive real returns on your debt. Basically, those bondholders have to be the bag holders. So you have to, that's the situation we find ourselves. That's kind of peak fiat. When you're this far into the system and all these debts have built up, that's kind of the release valve that you get to. Very few people. There are days where Japanese 10-year debt does not trade, which is remarkable. These markets are supposed to be very liquid, but in Japan's case, because it's been such a managed market for so long, that the market has basically left. And so other than pools of capital that pretty much have to hold it and the Bank of Japan, there's really few buyers. Now, some people might go in for a trade if they think, something might happen in a near term, but there's very few pools of capital that want to hold these things for long periods of time, because you're being told up front, we're going to do everything in our power to make these lose value slowly, right? And so most pools of capital do not want to hold them. And so the biggest buyer ends up being the Bank of Japan. Basically, the central bank owns the debt of the government by creating new money to do so. So it's this big, like, recursive, turtles all the way down fiat situation.